Good morning, everybody, and welcome to the Daily Energy Market Podcast. It is the 8th of October, and we have Brent crude oil coming off a bit this morning in early trade in Asia. Brent is down 2% at under $80 a barrel, 79.37 after closing yesterday above $80 a barrel for the first time in a while. Peter McGuire, CEO of XM Australia. Peter, meanwhile, in the background, behind all of this geopolitical noise, China offered a fairly substantial stimulus to the markets 2 weeks ago. It had another sort of introduction or announcements today. Equity markets have rallied quite strongly in recent weeks. Has China's announcement and its rally had anything to do with this 10% climb in oil prices in the last week, or is it all geopolitics? Your thoughts on the intersection of China's role into uplifting oil markets?
Well, Sean, and good morning, good afternoon from Sydney. Lovely to be here. I think there's so many different moving parts when you look at the China situation and what we've experienced in the last 2 weeks. As you know, they're on holidays for the best part of a week. I'm just noticing the CSI 300's up 4% today, but you've got Hong Kong down 7% and some markets in Hong Kong down 9% for the day. So I think that the actual uplift as far as Chinese equities is going to be maintained for pretty much the rest of the next couple of weeks. Let's see how it rolls into November. But at the moment, it's a lot of hot talk and there's a lot of hot action and people following the market. As far as demand pitch is concerned, they want to re-engage China naturally and just get all the engines moving in synchronicity. And at the moment, in the past, it's been fairly fractured. And this has got to be interpreted from not only funds flowing into China, but the domestic engine has got to really start to be engaged, and from the property sector all the way through to manufacturing, and the end user has got to be consumption internally. You can't argue with the numbers. Some of these markets, Sean, are up between 25 and 43% for the month, and that is just quite extraordinary. I don't think I've ever seen a stock market up 40, or any index up 40% in a month, and that's what's been achieved in China. So it's dramatic uplift, and maybe it's going to be a continuation for up until December 31, but I think that could be a bit of a stretch.
Peter, looking again at the fundamentals of China, how do you dissect their stimulus efforts? Because apparently there was or at least there was some expectation today of that the Chinese economic announcements that were going to be reinforced today with more. What's your analysis on what's in the stimulus box that China has announced 2 weeks ago? What is emphasized today? Your thoughts on its velocity to change the direction of travel for such a massive economy like China?
Well, if you look at Bloomberg, and thanks, Sean, you look at Bloomberg and right now, and it says China vows to hit economic goals, stop short of large stimulus. So, well, that says it all in a lot of ways. It's a wait and see approach. I think they've come back from this week off. They've seen the massive reaction in stock market pricing. You've had the CSI roll from 31 to 4,100. So, you're up 1,000 points. It's been dramatic. So I think it's a time to just inhale what's happened. And then they'll take a staged effect and see, first off, they've primed. Secondly, how much performance you're going to get out of internal combustion, and is it going to be successful? And then in turn, naturally, the next pathway forward is going to be a drip feed of larger stimulus measures, possibly to re-engage property sector, manufacturing, and get that whole infrastructure base back on track. Obviously, I haven't been there for a number of years, but obviously it's hemorrhage. And it's hemorrhage because of large property overhang as far as unsold properties. And you've got a lot of debt, so that needs to be managed. A lot of external debt is held by international banks and, of course, domestic banks internally. So all of that needs to weave its way through the market and see who, at the end, if they can get away without a crash happening. And that's the whole agenda, because they don't want that mechanism to play out. And I suppose the first part naturally is get the equity market on fire, get confidence back into it from a sentiment perspective, which has been effective. You can't argue with the numbers. I mean, it's pretty hard to say, if you haven't been long Chinese equities for the last couple of weeks, where have you been? That's pretty much the storyline, Sean.
Copper prices recovered back up to near $10,000 per metric ton, which of course is a big indicator for the Chinese economy moving forward, if you like. Your thoughts on the China stimulus and its sort of euphoric uplift, its sort of knock-on effects to other markets, both other commodities and other geographies in Asia?
Well, first off, yes, Sean, you're just sitting at 99.29 for copper at the moment on the LME. So it bounced and it bounced strongly from that 9,000 handle, and it was well bought up in the sense tin, nickel, lead, zinc, they all had a run as well, and aluminium. So it was a fairly strong, robust rally, and it's holding at that sort of number. Where that rolls across iron ore prices, I wouldn't be surprised for that to actually move up as well. And in a lot of ways, they were probably oversold to the downside. The next part, it needs consumption. You need to get the purchases of all these finished goods. It's either going to be consumption internally, and that's domestic consumption for China, and then external across the fabric of Asia and naturally into the West. And that requires people not to be tapped out on credit cards. It requires earnings to be strong for companies manufacturing goods and for an appetite out there to buy those finished products, Sean. And is that going to continue or re-engage? Consumption across, if you're looking at consumption across the US consumer, it's relatively still fairly strong from a resilience factor, but inflation hasn't gone away in a lot of ways. We've got numbers being released, but if you're looking at inflation for services and, for the likes of home insurance and all of these sort of add-on costs that the consumer feels, they're at sky-high prices. I noticed the longshoreman had struck a deal for a 6-year pay rise over a 6-year window, 63% increase in their pay packet over the next 6 years. So you can't say that they're not, if they're getting 63%, Sean, there's a lot of consumers out there that are also going to put their hand out for higher wages. And is that going to be enough to, aid China?